Okay, fine. Thank you very much. Yeah.
It was okay.
So Bharat will be joining us in a couple of minutes. Please be patient.
Good to go? Yeah. Sorry for a small hiccup. There was some hiccup here. All right. So far, we were discussing about a lot of strategies based on the equities, right? Today, what I'm going to do is I'm going to discuss something not directly related to equity, because before we start investing in equity or wherever we're investing right now, we have to take one bird's eye view of what is happening across sectors and across different asset classes, right? That becomes very important in what actual economic regime that we're right now sitting on. So what we're going to do today is we're going to look at, okay, equity is one of the asset classes. One of the smallest asset classes is equity, right? The bigger asset class is basically the currency, then comes the bonds and commodity, and then comes the equity. So equity will definitely is not a standalone asset. There are a lot of other things which are linked to equity. So there are a lot of other factors which will influence the equity market, right? So we'll have to take once in a while, once in a quarter at least, we have to look at, okay, what is happening across other asset classes. So that could probably affect equity, right? We should also understand, okay, where am I sitting in terms of equity? What are the risks that I'm going to assume as an equity investor? That we have to assess always. So that is the attempt that we're going to attempt to understand what is happening in the other asset classes. So whether we are in a comfortable place, or do we have to worry about a couple of other things, right? That is what we're going to discuss. So before I go further, let me give you a quick about what is happening. See, there is a money sitting in the on the table, right? Whenever there's a money sitting on the table, so there are 4 places where this money could actually function, right? That means money will not stay idle because there is inflation that is coming into the market. So there is always a urge to put this money elsewhere so that this money will start earning for us. So where are the 4 places that we could probably commit, right? So one is probably the currency. In Indian market, currency aspect is not there, but outside India, yes, there is a currency market which is still running. Currency is one of the places where we can allocate our money, right? Diversification we always speak about. We always speak about diversification within the asset classes. As in equity, we look at, okay, different sectors, we look at asset diversification. But we don't think about, okay, diversification at a very economic level, right? This is what global firms will do. So they commit part of their money to currency. They assess what is the best place where the money could earn. Money has to earn something, right? So they'll assess, okay, which is the best place to put their money at a given point in time. Currency is one of the places where we can commit our money. Then comes the bonds, fixed income, correct? And third one is commodities. In commodities, again, we can go into sectors saying that base metals and bullion, agri commodities as several classification there. We are not going to classification there. Now then goes into equity market, right? Again, in equity, large cap, mid cap, small cap. See, when things are not looking good, we probably tend to go into defense sector like FMCG and pharma and a couple of other things, or maybe look at large cap. So if equity market as a whole, if we don't want to take too much of risk in the market, so we look at mid cap or not mid cap, we look at large cap or very what do you call defensive sectors, right? Like that also, not only just looking at diversification within equity, we also look at diversification in terms of other asset classes. So which is the biggest asset class? Equity is not a biggest asset class in the world, right? This is one of the asset classes, yes, no doubt. That is actually the largest, smallest one. Which is the largest one? The currency is the largest one. Then comes the bond, second one. Then goes to commodities, third one. We have to understand what is the relation between these things. Textbook wise, what is the relation between currency, bond, commodity, and equity? What is going to happen in terms of intermarket relationship? When is equity favorable? When is bonds favorable? What is the current scenario? This is what we'll understand. Correct? So currency becomes the very biggest market, because if currency goes up or down, you can actually make or break a country, right? If let's say tomorrow morning, if currency depreciate further, let's say right now we're sitting at 94, 95 versus dollar. If it goes to 110, 120, let's say, not tomorrow, currency cannot move like that over a period of night. But I'm saying if by chance, if currency keeps depreciating like this, Indian currency, so it is going to, our country will suffer, because we are net import economy, right? So our import cost will drastically increase. So that is one of the concerns we have to keep in mind. So that means a currency fluctuation can actually shake the country. The bonds are basically the fixed income asset. Basically, the bonds, and the bonds, the government bonds, sovereign bonds, and other corporate bonds, which basically the way of funding the economy is coming from the bonds only, right? So they fuel the economy. Commodity is basically, this is where you understand what is the inflation that is coming on, right? This is where inflation comes into place, where you can look at the commodities. What is inflation basically? Right, you all the basics of economy, you know what is inflation is. I'm not going to details of what is inflation and how it affects us. So basically, why inflation increases? Basically, the commodity price start increasing. Let's say the crude oil is going up, and when the crude start going up, what will happen? Even the transportation will go up. The food articles will go up because the food has to be the food articles has to be transported from the place where it is produced to the place where it is consumed. So again, the crude going up will affect so many sectors. Even the part of power generation comes from the crude, right? The coal and other resources, right? So basically, the crude going up will definitely hit an economy because of inflation, right? Inflation. Then comes the equity. So net. So how these three things are playing out will decide, okay, what is going to happen here, right? This is what you have to understand. So what is the relation? Basically, the relation is between 2000 to 2020, 21. Basically, it was a certain relation between equity on bonds and equity versus a commodity. Basically, I'm speaking about crude. I'll speak about gold later on, but crude. So how is equity related to the crude oil? How it's going to affect? Along with that, how is equity related to the bonds? How does it function? So basically, between 2000 to 2020, 21, the relationship was different. Now the relationship has changed. So what is the relation? Basically, if you look at this one, there's a basically between 2000 to 2020, there was a high demand scenario, right? High demand. So high demand for consumption, all those things, a lot of consumption was happening. Even no consumption happening, but this is the scenario between, I'm trying to establish what is the relation between equity or the stock market versus the bond market. How the relation existed till 2020. It was a high demand scenario. What will happen to high demand? High demand will lead to high economic activity, correct? The high economic activity will lead to what? Higher valuation in the stock market. That higher valuation in the stock, since there is a lot of demand, a lot of consumption is happening, so a lot of consumption of commodities are happening, so that will lead to higher inflation. If the higher inflation is happening, so what is RBI will do to curtail this inflation? They'll increase the interest rates, correct? So basically, what was the relation between stock market and the interest rate here? If you see, if the stock market starts going up, inflation will go up, correct? Because of demand and what consumption, and the interest rates will also start going up to curtail the inflation, right? So basically, there was a positive correlation till 2020. So what was the risk in the market? The risk in the market is demand. High demand is a concern here, because if demand start increasing like this, inflation will start increasing. So we are forced to increase interest rates, right? So there was a positive correlation. When I'm speaking about relation, the positive correlation, that means they were more or less in the same direction. Okay, so look at this scenario, right? This is the correlation between stock market and bond market. So if you look at the correlation here, right, what was happening till 2000, there was a positive correlation in the market. That means the stock and the bonds were more or less in the same direction, correct? From 2000 till almost 2021, 2022, the positive correlation was there. That means stock going up, bonds were going up. There was a positive correlation in the market. Now the market has gone into negative relation. So what is the risk between 2020 to 2023, 2020? This 20 years, what was the risk? The risk was always the demand. Oh, there is a demand. If demand starts going down, there will be devaluation of the stocks, right? So if the demand starts going down, there is a concern of the stock market going down because the valuations will go down, correct? So the demand was a risk in the market. Now what has happened is the relation between the stock and the bond prices have gone into negative side. It was also negative here before 2000. The negative here and the negative here is not the same. Why the negative correlation between stock and bond is not the same here? Because till 2000 there was a lot of IT boom that was happening. So the IT boom was happening. Now if you look at this chart here, let me pull up this chart. So this is 10-year yields. You can see this is 10-year yields. Now along with 10-year yields, what I'm going to do is I'm going to put a SPY. SPY is basically the US SPX. So I'm going to put on the new scale. And I'm trying to show you what was happening here. So I'll go to a weekly chart and I'll show you what is the relationship. How the difference was different then and now. So take a look at this, what was happening here. So the candlestick that you're going to see is basically the interest rates, and the blue thing is basically the stock market, the index. S&P. So what was happening here was, if you take a look at this, the stock market, basically it was going up because of all the IT boom and all those things. It was going up. Along with it, what was happening here was, see, IT was going up till 2000, 2001. Interest rate was coming down. This is a 10-year yields. Basically, this is a 10-year yield curve of US Treasury, okay, government bonds. So what was happening? So the stock market is going up. This was a interest rate was coming down. That means there was a relation between this is negative. But here what was happening was, stock market was going up. That means valuations are going up. Demand was also there, but inflation pressure was not there in the system. That's the reason the interest is going down, right? The negative correlation was there, but this was good for the economy. Why it was good for the economy? Government need not worry about inflation. Correct? The government need not worry about the inflation. So though it was negative, the relation between the stock market and the interest rate was negative, it was good because they need not worry about inflationary pressures in the market, right? Now what is happening here is it is different. Now the relation has turned negative, but now the concern is definitely not the what do you call? The concern is different, not the demand side. Here there was demand. That's the reason demand was there. Market was going up. Stock was priced at a very high valuations. This was good. Interest was coming down. That was fantastic. Now what is happening here is it is not the same. It is not the same. What is happening today? If you look at this particular chart, right, the correlation between the stock market and oil prices are different. The risk was till 2021. The risk was demand side. Too much of demand will lead to too much of inflation. Then we have to worry about other things. Now it is not the concern of the demand. It is the concern of the supply side. Why it is a concern of supply side? When I say supply side, what do you understand? Supply shock. That means what is happening today is, understand on a higher level what is happening in the geopolitical scenario. There is geopolitical scenario. Because of what is happening, the crude oil prices are actually going up. Right? We were at 60, 65. We are above 80, 90. We are sitting around there on an average in the last couple of months. Supply is a problem. Not only that, take a look at this. This is also confirmed by this one. Correlation between stock market and oil prices. Even stock market and oil prices, the correlation is going negative. That means it is confirming that the oil prices supply is a concern now. The state of Hormuz, we are already know that geopolitical event, all those things are actually adding to the supply side concern. If supply is going down now, correct? Because of what? And not only that, you take a look at this one. This is a US energy information. It is energy. They are telling you that US stocks of crude oil, the strategic, they'll keep a strategic petroleum reserve that has become almost last 40 years low on the crude oil that they are holding in their as a stock, right? In their inventory, it has come to 40 years low. That means it is saying that supply of crude oil is coming down. If the supply comes down, what will happen to the prices of crude oil? It will go up. Not only the geopolitical event is also adding to the flavor there. It is actually creating one more. Okay, there is a disruption in the crude oil. So crude oil is going up. That means inflation is going up. Inflation is going up now. It becomes a supply side concern. In 2000, it was not a supply side concern. It was a demand side concern. Now the supply side concern comes into place. But why are you worried about supply side concerns here? The equation is entirely different. 2000 to 2020 is a demand side concern. Now it becomes a supply side concern. Inflation will also be high. There, equity market is going up. Everything was going up. Inflation was going up. Here, demand was also there. Here, supply is a concern now. If the supply starts becoming a concern, we will actually go into supply shock now. Inflation will be high. Inflation is high. Yields are going up. Correct? Negative stock bond correlation is emerging right now. Right? It is a different scenario. The stock to bond correlation is basically on the negative side of the market because of supply side concerns. You understand what I'm saying? Concerns, questions? Let's go further. Basically, the equation that the table has tilted now. Inflation is high because of supply of the crude oil. Because of that, equity market will take a hit here and there. Valuations will also will take a hit, right? Now the concern is not necessarily the demand side, it goes onto the supply side. So now this is the macroeconomic picture that we have to keep in mind, right? Now concern is, okay, Bharat, if equity market goes down, what is the concern? Yes, equity market, we have to start going into the debt market, correct? Gold as a strategic edge, gold is also sitting at a very high price. Gold is also not on the lower side. Gold is also almost close to an all-time high, right? Maybe 10-15% here and there. So now if the equity market starts going down, gold as an inflationary hedge is also will be a concern, because gold, if you look at the gold chart here, if you look at the gold chart on this side, what will happen on the gold chart? Gold has a certain harmony in the market. Gold will move not in one go. If you look at this, once in a decade, it will grow, it will go crazy, okay? And it will go stagnant for a couple of years, basically. That is how the gold behaves. See, take a look at this gold market, right? This 2008, 2009, there was a lot of concern with the equity market, correct? Almost interest rate was almost zero. Equity market was struggling, right? There was a Europe concern. There were a lot of countries in Europe, they were going default during that time, between 2008 to 2012, right? A lot of concerns were there. So what was happening? Gold will go between 2008, 2009, all the way towards 2011, 2012, it went up. After going up, what will happen to the gold? This is the scenario. This is not a recommendation. This is how the gold behaves, basically. So now for next 10 years, gold did not go anywhere. Almost 10, 12 years, gold did not perform anywhere. Now again, last couple of years, it has shot up. Now, will this repeat the same thing as a hedge against inflation, as a hedge against equity market? The equity starts tumbling. Classically, we used to go into gold as a safe asset. Now, can we do it after this exponential growth? Equity is up, correct? Now, what is the scenario? Equity is almost close to all-time high. Interest rate almost close to all-time high. In the US market, I'm saying. Gold is also almost close to the all-time high. Where should the money go? All are sitting at a very high price. This is where I'm saying the scenario is different. In 2008, the whatever we faced in 2008, where there was a crash in the US market, Indian market, we had at least gold to go. So, okay, equity market is crashing. Look, okay, let's go into gold. Gold actually performed. Correct? Gold actually performed here. 2020, at least gold was stagnant and interest rate went up also there, right? So here there was some concern with, okay, gold would have been a concern, not a concern here. Now what is here sitting here? Gold is also all-time high. Equity, interest rate, gold, all at all-time high. How do I switch? If I switch also, what is the concern now? What is the risk I'm going to assume in the market right now? Correct? I'm making sense? So this is the risk that you have to keep in mind. Okay, if something goes wrong from here, is it going wrong? We will look at it. We'll look at what is going wrong, what is not going right, right? So how do I assess Bharat? How do I assess this? So given the scenario, you are saying that all these things are at all-time high. How do I assess it? So I want you to look at a couple of things. So what I'm going to look at is, this is gold. I'm not going to look at gold alone. Rather than looking at gold, I would want to compare the fear in the market. How do I compare the fear in the market? Do you know, we know this, right? CBOE VIX. We know the CBOE VIX. What does it VIX speak about? This speaks about what? This speaks about the fear in the equity market. So volatility, S&P 500 volatility index, this basically speaks about what? This speaks about the fear in the equity market. Let's put all those things together, because we understood, what we understood is, if the equity is a concern, it might go to gold, right? Or it might go to interest rates, correct? If equity is a concern, money will flow into gold or money will flow into interest rates, correct? And we'll also put crude oil here. So we will compare, because crude oil will add to the inflation pressure, inflation in the market. So now if I want to compare, what is going to happen? I will compare the fear in the gold versus fear in the crude, fear in the interest rates, fear in the equity market. All four I'm going to put together. You'll understand how this would have worked. So what does this mean? So I'm going to put all four things together. So now what I'm going to do is, I'm going to put this is called as a MOVE index. MOVE is basically the Look at this. It's a BOFA, Bank of America, US bond market option volatility. So now I'm going to put in a new pane. Okay. Now GVX. GVX is basically the gold. Wait. What was the gold? Let me pull it up. Gold volatility index. Gold volatility index. Volatility index. Gold hedged. What is that? GVZ. GVZ. Yeah, gold volatility index. Correct. I'm put gold volatility index. I'm going to put crude volatility index also. So you look at everything so that you'll understand what is happening here. Gold, GVZ. New pane, GVZ is a gold volatility index. Now I'm going to put OVX. It's OVX basically the CBOE crude oil volatility index. So I'm going to put in the new pane. So this will give me the entire picture here. Correct? What is the picture that I'm getting here? What is the picture I'm getting here? This one is basically the fear in the market, equity market. This is the fear in the bond market. Now this is the fear in the gold market. This fear in the crude market. But why are you put four things here? Because each speaks different. Which speaks about economy. This will speak about fear in equity. This will speak about fear in the bond market. Volatility in the bond market. This will speak about volatility in the gold market. Because equity fear is there, volatility increases. When volatility increases, we'll see that. This is crude oil. If geopolitical event happens or some concern is happening, your volatility or the fear in the crude oil increases, right? If volatility in the crude oil increases, inflation increases. If inflation increases, interest rate should increase. If interest rate should start increasing, right? Edge against inflation, gold volatility will increase. Correct? With all these concerns, now this will also start having volatility. Right? All are interconnected. So now I will look at what is happening here. Correct? What's happening here? Look at 2020. Usually the case is you will get at least 1 or 2 weeks ahead, you will see bond market giving you clues. It is not the equity market that's going to give you clues, right? It is usually the bond market that is going to give you clue. I'll put bond market here. What is the bond market? Which one is MOVE index? I'll put in the top panel. So you'll understand, okay, Bharat, how do I assess the risk? Take a look at this. It might go a little above your mind, but pay attention. You have to understand all the aspects here, right? I will put VIX into a different new pane. Okay, now this I'll remove and show you what is happening. Take a look at this one, the 2020 fall. The 2020 fall. What was happening here in the 2020 fall? All four was telling you that there is some concern here. Because last couple of weeks of high, the volatility, you know VIX, right? VIX is basically the fear index. We look at VIX, like India VIX. It's a options pricing. So the option market is pricing here, right? This data is from CBOE, correct? So now you look at this one here, your equity market was slightly lower. Take a look at this one, this bond market, at least 1 week ahead, there was a spike in the volatility of bond market. There was a spike in volatility of gold market. There was a spike in volatility in the crude market. And then there was a volatility spike also in this one. So when all four things are going together, this is telling me that there is some concern, serious concern in the economy. When all four are in the same direction. When all the four volatilities, so all four markets are giving you the same concern for me. It is not always the case. Now recently, if you take a look at this one, this market here, correct? Take a look at current scenario in the last couple of years. What was happening here? is the bond market volatility has increased. The bond market volatility has actually increased in the current scenario. Horizontal ray. Let's take a look at this one. The volatility in the bond market is high, but this is not coupled by the volatility in the gold, volatility in the crude, volatility in the equity market. What is this concern? Bharat, what is this telling me? Only if and only if the bond market volatility is increasing, that means this is concern with the financial institutions, right? This is a concern. There is something going on with the financial institutions. If all four are in the same direction, someone is seriously. Please can you mute Okay, thank you. It was that chart. Yeah, here it was. So if only the bond market is going up, it is not coupled by the volatility in gold, volatility in crude, volatility in VIX or on the equity market. It is telling me that there is a pressure in the financial institutions. It is only the concern with the financial institutions. It has nothing to do with the overall market scenario. Correct? Now you look at last week. I'll go to 2007. Bharat, what was happening in 2007, 2008? So I'll go to 2008. You will see one distinctive feature is, take a look at this one. Equity volatility was not going up till what time? Take a look at this one. 2008, everybody remembers that there was some concern with financial institutions, right? The Lehman Brothers bankruptcy, a lot of, we know the story. We don't have to go there. See, equity, this is the equity market volatility. In the equity market volatility, what was happening was the volatility of equity was not going up. That means this is telling me the bond market was going up. Bond market volatility is going up. Higher highs and higher lows is being made. It has broken the volatility fear of last couple of years. It was actually at a 3-year high. Volatility of the bond market. First pin is the bond market. It was high, right? And now equity market volatility was not increasing. This is telling me that equity market is not pricing in the risk here. Bond market, whatever bond market is calling, it is not pricing in. After that only, this bond market gave the first clue that something is going on with the financial institutions. That had a ripple effect into equity. And the last leg of this volatility spike that came in equity was when the Lehman Brothers announced bankruptcy, the panic mode. Last phase is where the equity market realized, okay, there is something really going on. And the fear spiked up. But there was already a clue in the bond market. Even gold did not give you the clue. Gold increased actually at the same phase as equity volatility, but bond giving you the clue. So always look at all this. Set up your system like this, wherein you see all the picture, the entire picture, the bond, volatility, CBOE, all from Chicago Board of Options Exchange. Making sense? Yes. All four in the same direction, something is definitely going wrong. Take a look at 2020. All four in the same direction. This is telling me something is going wrong. Only if this bond is going up, equity is not pricing in right now. It is telling me that there is some concerns with the financial institutions. It might go up. If it sustains, take a look at 2026, last geopolitical event that we had in 2026. So what was happening? Gold was pricing in little faster. It was pricing in, correct? Crude was also pricing in little later. Bond was actually it has already gone up substantially in the last couple of years. If you see the interest rates, 10-year yield and 30-year yield in the US market, it is sitting at almost 10-15 years high. Why this is happening? Right? So keep all four in place so that you understand where the fear is. Only bond market going up. Assume this is a financial institution. Some concern is there. Pay a little more caution to what is happening. If that is coupled with a scenario like this, where this all four join the hands, yes, this is serious concern with the market. Usually some bond will give you a heads up. Before equity does, bonds will give you a heads up there. Is that clear? Now, what is the current market scenario? Bharat, why is bonds going down? If you look at last week, there was a payrolls, right? The jobs data of US, it is telling me that there is less number of jobs being added, right? Less number of jobs being added in the last couple of months. It is going into negative territory. This means what? The economy as such is not in a very strong footnote. That is what it's telling me. So if the jobs were adding, what will happen if jobs keep adding? They'll get money. If they get money, they'll start spending. If they start spending, inflation will come in. So they are now the Federal Reserve is forced to increase the interest rates. Forced to increase the interest rates. Since the job data was not that great, not enticing, what happened? The probability of interest rate increase came down. This was good for the market. It cheered because if debt increases, right, there's a concern, serious concern for equity market also because there's a debt component in all the books, right? So since the job data did not come well, it came as a disguise, boon in disguise. That is why the volatility, bond volatility is okay. Now the job data is not going great, so the probability of increase of interest rate in September has drastically gone down. This is changing in the market, and inflation pressure is also coming down. You can see this is the fear of what? Crude oil volatility. The fear in the crude market is also coming down. That means inflation pressure is coming down. Jobs data is not great, so the probability of interest rate increase is not actually high. So that is the reason you also see the bond market volatility is coming down, right? This is also putting equity market at a sweet spot. Okay, good. It is also keeping, see, those fears you should keep in the hindsight. Doesn't mean that you start acting on it. Okay, because they don't align on in the real time basis. There will be lag in the alignment of equity, bond, currency, and all those things, right? There will be lag, right? So now this is telling me that the fear in the market is actually coming down. It is only the gold sitting slightly higher in the last couple of months. Otherwise, all these things are cooling off, especially equity volatility and the bond market volatility is coming down. So immediately, is the fear is there in the market? No, the fear is not priced into the market. All four are more or less non-correlated, all going down. The fear in the market is basically on the lower side. Not only that, if you take a look at some stat here. What is the stat? This we look at a skew. There's a lot of options Greeks coming in. This is called as a skew here. What is the skew speaking about? What is basically skew? Let me draw a certain. See, now we look at the skew. Volatility, we call it as volatility skew in the market. This is coming live in next option soon. Maybe in couple of weeks it is going to come live. So what is this going to tell you is about? This is going to speak about what is the volatility on the far OTM puts and far OTM calls. Basically, what will happen is the skew will be like this. The skew will be like this. That means it is telling me that the VIX or the IV, basically, the IV of puts is slightly higher than the IV of calls. This is what it's telling me. How does it tell you? Like this. This is the baseline. From here, you look at the calls of OT, and this will be puts. Right? The further you go, this is OTM. Further you go, it is OTM puts. This is OTM puts. This smile is telling me that, right, the IV, this is basically the IV. This is telling me that the IV of puts is basically higher than the IV of calls. Why IV of puts is greater than the IV of calls? This is telling me that somebody, see, if you are holding some equity portfolio, there is always a fear of market coming down. Since the fear of market coming down is there, what you do is you start buying puts. When you start buying put options, what will happen? The demand for put option increases. When the demand goes up, the premium will go up. If the premium goes up, the IV is more. That means when the put option is basically higher, the IV of put options is higher in the market. That means somebody is buying put option for a hedge against their equity holdings, right? Now, if the IV of put is lower and IV of call is going higher, that means this market is telling me that people are buying call options. That means they are basically bullish in the market. They are basically bullish in the market. They are not concerned about downside risk. That's the reason they are not hedging it. See, this is exactly what this slide is telling you, right? What is telling you? This is basically the 25 delta. What is delta? Again, it's an option delta, vega, theta, gamma, rho. I will not go into the specifics of what is happening. I'm giving you a scenario wherein, though there are a lot of concerns with inflation, there is a lot of concern with geopolitical event, right? The bond market fear is not there because of the bad employment data from the US. So a risk of increase in interest rates in the near term is not there. So bond is cooling off. Since a bond is cooling off, interest rates are cooling off, equity market is cheering it up, right? Gold is also not telling you that there is some concern there. Gold is also little cooling off. So the concern in crude also is coming down because you saw the VIX also coming down on the crude oil VIX is also coming down. So the fear seems to be not that great, right? That is what the 4 asset classes are telling you that, right? Along with that, this is telling me that, okay, so can I push money into the market? I do not know what this data is telling me. This is coming from, again, CBOE. This is telling me that skew is coming down. The skew, basically, usually the put skew will be more, call skew will be less. Now what is happening is the skew on this one is almost 1 year low. That means there is a lot of call. So the call side skew is slightly on skews on the call side. That means somebody is buying call options. The hedging on the put option is not happening. So the risk, downside risk on the equity market, basically this data is telling me that it is coming down. That's the reason the skew is shifting to the call side. Getting my point? So people are buying call options. This is what this market is telling. Again, this is not a recommendation. This is what the data is telling us. The fear is not there in all 4 scenarios, right? Watch for bond market fear. If there's something happening in the bond market, there is definitely a fear. Correct? That you should always keep in mind. I'm going to delete this, right? If you want to know how to add this, let me know. We will probably share how to add it. Look at Dow Jones. No, not a recommendation, basically. Dow Jones or S&P, right? That data was telling me that there is no fear in the downside. This data can change tomorrow, right? That is not I'm recommending. This data can change tomorrow. So what is happening in this market? I can clearly see higher highs and higher lows are happening in the market. That is what the data was telling also, right? This Q was telling that the fear is at the lowest point in the Dow Jones, S&P also. It is S&P. You can also take a look at S&P. Right? See, this is the actual data of S&P. It's going up. Fear is on the lower side. It basically just broke the consolidation that it was showing up, correct? This consolidation has been broken in the market here. This is what exactly. So when the consolidation broke, the market started buying call options. Hedges were not taken seriously. So the skew is on the option data is suggesting that there is no fear on the downside. That is what data is telling me. I am not telling you that. Okay. So now given the scenario, what is the best way of looking at Indian market? So I'm not going to discuss about Indian market. I'm going to discuss only about where is the money going, right? Okay, there is no fear. So we can plausibly think that, okay, the equity market is more or less looking safe in terms of fear, right? What is sectors doing? What sectors are doing well? This is Bank Nifty. Bank Nifty is still lingering around, right? More or less on a sideways market. So Indian market is still struggling around the, right? Take a look at this. This market is struggling sideways, stuck in the sideways zone. So banks are not, the bank index is not looking bearish, not looking bullish. Also, it is stuck in the sideways zone. So where the money is going? Is it money going to next 50? Yeah, this seems to be looking good. Next 50 as a sector has broken. So this is agreeing with what? Agreeing with what is happening in S&P also. It has broken. The consolidation has been broken in Nifty next 50. So next 50 looking good. What is happening in mid cap? Mid cap is also breaking all-time highs. Mid cap is also breaking all-time highs. Right? What is about auto? Small cap. What is happening in small cap? See, the biggest problem, if there is any fear, so I said bond market will give you a hint that something is wrong in the market. In the equity market, which are the first stocks, first index to fall? It is basically what is going to fall is basically small cap, because they don't have that deep pockets to sustain any issues, right? So the deep pockets is not there. So this is what is going to happen. So small cap is looking good. It is still not concern. Because why is not a concern? Because it is showing me higher highs and higher lows, higher highs and higher lows. Every time market comes to this moving average, this is a 50-period moving average, it is bouncing off. So if by chance, if there is a dip to 50-period moving average, there could be a bounce off. Correct? This is what small cap is looking good. No concerns, because the first one to crack is small cap and mid cap. They are breaking resistances. When they break resistances, fantastic. Now what is happening in auto? Auto is also looking great. It is breaking resistances in auto, also breaking resistances. Metals are also doing fantastic. Right? Last couple of weeks, metals also did fantastic. Yet to break the resistance, small cap, mid cap broke the resistance. Metals yet to break the resistance, but it is not showing any signs of breaking the support also. So mid cap, small cap, and Nifty next 50 seems to be breaking resistances. Auto also breaking resistances. Fantastic. What is happening with pharma? Pharma is one of the probably the strongest sector, if I see right now with all those things, is this one, because it is higher highs and higher lows, higher highs and higher lows. This 50-period moving average acting as a support, sloping up. Everything seems to be fantastic in pharma. So pharma attracting money, auto attracting money, mid cap, small cap attracting money right now, right? Oil and gas, laggard. I don't see much of a thing happening in oil and gas because it is still struggling to break. So Bank Nifty, banks and oil and gas seems to be not performing. Energy also not performing, making lower highs and lower lows, unable to break resistances, not breaking resistances. Correct? So seems to be on that side. The commodity business also not great. FMCG definitely not looking good. See this? That means defense sector, this one is certainly way far away from the highs. It's still making lower highs and lower lows, unable to break any of the resistances. FMCG is not a sector where I would probably look at it. Healthcare is looking good. So pharma along with healthcare looks fantastic. Correct? Is PSU better or private banks better? So look at this. Private banks is making lower highs and lower lows. Right? Why am I saying this? Is because of this. If you have any questions, you can start asking. Right? It is making lower highs and lower lows. With respect to PSU, it is almost on the verge of breaking resistances. PSU banks. Correct? So basically what I understood is banks are struggling. Bank Nifty is struggling. Metals, okay. Definitely FMC is struggling. ITU, we already know the story, right? It's bouncing off from the recent lows that is happening. So basically, if this resistance starts breaking on the IT index, so maybe this looks fantastic. That means if this has to break the resistance, what should happen? Understand this. If this has to break the resistance, so from resistance, if this fall is going to come, this fall will come because of whom? Sellers. If the sellers are not strong enough, there might be a bounce off from 50-period moving average. First change, second change of polarity. If you remember the last couple of webinars, change of polarity. This fall is small. This would give rise to a inverted classic head and shoulder pattern. I would expect this, if this is not going below 50, that means head and shoulder inverted will happen. This might give you a chance to see a breakout in IT. Right? This is what I actually see. So on the inside, pharma, healthcare looks fantastic. This is what I see. Right? IT, yes, there is a certain bounce in the last couple of weeks. Am I expecting a head and shoulder pattern inverted? Classic patterns. Right? Any questions here? So what is the conclusion? Yes, though there is a supply side concern. Why is supply side concern? Because crude oil supply might be hit because of geopolitical event, right? So there is a risk of inflation. There's a risk of inflation, there is a risk of interest rate increase. Only because of jobs data being bad, interest rate was not increased. Correct? You know, high crude oil prices is not good for Indian market. We are net importers of crude oil. So if that concern happens, we have to be extremely careful what is going to happen. So watch crude oil, any volatility in crude oil, you keep watching it. Now internally, mid cap, small cap is not giving you any sense of concern. Along with the defense sector, FMCG is not going up. That means money is not moving into defense sector like FMCG. So immediate fear is not seen. Is that clear? Along with that, if you look at one more metric, any questions you can please shoot at me. So look at this one also. There is one more positive thing which I see is money control, FI data. Go to money control, FI data. Wherever you feel FI data is good, please go take a look at it. So August has seen a very positive flow from FIIs after almost a year. Okay, so cash market. If you look at monthly scenario, FI data. Take a look at this. Jan 2026, they were shorting. This is the first month I see that FII have actually bought in the cash market. 3,600 crores to the tune of 3,600 crores. Right? There have been net sellers throughout. Right? Take a look at this Jan. Last time, when did they give you positive? June 2025. It's been almost a year and 2-3 months back. They actually bought in Indian market to the tune of 7,000 crores. This is the first time they have actually seen this. What is a good thing about this? So since the money start moving into the market, even the currency will also show some strength. Indian currency will also start showing some strength, correct? If you look at USD, INR. Please, if you have any concerns, questions, please see this. So if you see this, Indian currency actually moved from 96 all the way towards 95 in this August. So it is actually going along with what? It is confirming that, okay, some money is flowing into the market. Rather than dollar outgo, dollar is incoming here. This is what this chart is basically telling me. Are we out of the woods in currency market? Not necessarily. The support is still there. So it might go consolidate. All right. So FI data is positive, which is good. But they still hold net shorts in the futures market. Right? Unless and until they unwind this net short futures, go to F&O. Right? What they're doing in the index. What they're doing in the index, they are still holding net shorts in the F&O. See this? They're holding net shorts in the market because FI index shorts. Okay, they are not displaying that kind of a data here in the net shorts. See here. No, they are not displaying this data, but they are net still shorts in the futures, right? So that is one concern that we should be worried about. Otherwise, let's see how it's going to work out. Any questions? Overall, not much of fear is actually shown by the macroeconomic indicators. Even indices in India are also not showing much of a concern. So with that, I think I'll open this forum for any questions. If you have, please feel free to ask me any questions. Otherwise, take a look at all the economic indicators once in a while, please.
Yeah, please. If anybody has questions, we're running short of time. So if you have, we can only take 2 or 3 questions. If you have questions, you can ask them. I'll just unmute the mic. So any questions? You can unmute yourself and ask your question.
Yeah, yes, Mr. Bharat, very nice actually presentation. In fact, this is very good analysis. Like you started from this global scenario and then coming to Indian scenario and covering the different sectors, where this potential is there. And you're right, this pharma and healthcare are doing much better. And only thing is, can you please clarify on this defense sector? That means in defense sector also that is not showing potential.
Just because defense sector is doing well doesn't mean that you have to go and invest.
Yeah, correct. You are right.
So there is defense, manufacturing is there. Do we have the index for defense? Directly?
Yeah, Nifty defense is there. Yeah.
You can ask your questions.
Yeah, so I'm not able to find that directly.
Okay, yeah.
Right.
Okay, no problem.
Defense ETFs are definitely there that I'm aware of. But
Okay.
not sure that as an index as a.
Yeah. Okay. So the metal is also means okay.
Yeah, metal is okay, not bad.
Okay. So
yeah.
okay.
Because see, what is going to happen is, see, there was a consolidation here. So market broke this resistance. So if this resistance becomes support area, and if this 50% moving average is actually respected, so we could probably expect this higher and higher lows.
Okay, so metal side is, and auto is means much better shape compared to metal.
Auto, yes, auto is better. Now, when the problem is when we're entering, right? See, this is the mean, correct?
Yeah, correct.
Always stock will have too far away from moving average. You should never buy. This is a moving average, right? This is too far away. And if you put a Bollinger Band, last week I discussed Bollinger Band is probably outside 2ST. That means you're already buying at an outlier.
Okay.
The best price is it has to come down.
Okay.
So probably next week I'm going to make a video wherein how to buy there will be educational video on the channel, Tradejini channel, where I'll discuss about how to buy market close to a fair price.
Yeah, that will be very nice actually, because
I'll make a video on that. That is in the process. So I couldn't shoot it completely this week. I was shooting something else. So next week there will be one video where how to buy at a fair price, how to arrive at a fair price. Not when I say fair price, not in terms of fundamentals, right? It's technically fair price.
May I say, like maybe you can consider the VWAP and this EMA, a combination of these two. Maybe in future.
We will do that. Yes. VWAP is only for intraday. We will go much more than VWAP. Don't worry.
Okay. Yeah. Okay, sir. Thank you.
Any concerns? So
good evening, Mr. Bharat.
Takeaways, please do not buy too far from the mean. The closer it comes to the mean, the better it is because the risk is lower.
Yeah, good evening, Mr. Bharat. Lochan Singh this side, sir. Very nice presentation shared by you.
Thank you.
I've got few questions. You had mentioned about the skewness between the PE and the CE out of the money options.
Correct.
How to visualize that? Which particular graph should I consider, or where to get this information?
Okay, that will be coming down. I think we are close to launching it. Maybe in a week or two that you will see in next options. Okay.
Great.
Where do you see that? Is basically if you go to dashboard, move to next options here. That is called as volatility smiles and skews. Basically, I'll make a complete session on how to read that volatility skew. Okay. Because that will give you. It will come here. If you go to next option here, go to analyze here. Correct.
Yeah.
In this IV, there are only 2 tabs right now. There will be 3 more tabs which will come up.
Okay.
So volatility skew will come. I will make a detailed video on how to read the volatility skew because that will tell you what the markets are pricing in.
Okay. Yeah. Second thing, you had mentioned that how to view the FII positions in whether they are short in terms of futures market or not. Where to view that, sir?
I'll give you the source. Right now, this is showing in terms of cash. I have to read OI chart. Let me see this OI chart. Yeah, this one here. You can see this here, right?
Okay.
OI chart, not option sentiments. I want futures.
Futures.
Yeah. See. Okay. Yeah. Here. FII data. Right. Go to FII data. Go to OI open interest. OI chart. Take a look at this. They are sitting at. Look at futures OI data minus 1,68,702 contracts.
Okay. Okay.
In July, they were sitting at almost minus 2,66,925. Now they have done some kind of short covering.
Okay.
Some short covering is done, but we are still not out of the woods.
Okay. And sir, finally, in your charts, you have been using two moving averages. One is the 50-day moving average, which is the
10.
other one. Is it
Other is 10. Other is 10.
10 days? Okay.
Yeah.
Fine. Thanks, sir.
No problem.
You have addressed all my questions, sir. Thanks a lot, sir.
Thank you. Any other questions?
Sir, like you mentioned about this FI in the short for means more than 100,000. This thing is so. This is means still matter of concern, right? Compared to equity
So what I have
investment.
seen in my experience, whenever the Nifty or the Indian market has gone, because it's all index features, na.
Yeah, correct.
Unless until they do short covering and go long, right? The probability of Nifty breaking 26,300, 400 is slightly difficult.
Because of that long short is there as of now.
They're still sitting on short positions.
So that means this figure of 100,000 figure is that should mean it should come down. Means they should be on.
This has to turn positive. Net shots.
Okay, yeah, correct.
Okay. One session I'll do completely on how to read this data. How to read the future sentiment, how to read the options data on the FI positions, pro positions, retail positions, whatever that we have, right? The client pro and FIIs. So what data they're going to look at, right? So the FIIs, DIs, pro, client.
Yeah, that will be very interesting for maybe useful for everybody actually.
We'll do that. Don't worry. Yeah.
Thank you.
Any other questions? If no other questions, we can call it a day. Anything that I could answer?
Yeah, I think
More or less.
So, yeah, thank you very much for joining us, and wishing you all a happy Independence Day from Tradejini team.
Okay.
Thank you all.
Thank you, sir. Thank you, Mr. Bharat, for a very nice session. Thanks.
Thank you.
Thank you, Mr. Praveen.
Thank you.
Thank you.
Bye. Thank you.